Happy Sunday traders, this is the Option Trader Lounge, and in today's video we're going to be discussing how to double your account size under a year. So if you like this video, go ahead and hit the subscribe button, hit the like button for the algorithm, that way this could be recommended across YouTube, and that way you could get our future updates whenever they are released. So welcome to the Option Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Now let's get into it. So in today's video, again, we are going to be discussing how to double your account size using options. And the best way to do that, in my opinion, is by selling options. In this example, we're going to be using a $5,000 account. To double your account size is fairly simple, and I like to choose simplicity over complexity when it comes to trading. So the best way to do that, in my opinion, is by selling options, and specifically on stocks that have a strong moat or an ETF that is well diversified. Now, if we're looking at stocks specifically, I like to choose stocks that are well established, that have strong fundamentals, and that has a strong diversification in terms of their moat on how they can create revenue and profitability within the company itself. So in today's example, we are going to be using the almighty Lockheed Martin, ticker symbol LMT. Now we can see here that Lockheed Martin, and what I'm using here to chart is the TD Ameritrade Thinkorswim platform, and we are looking at the weekly chart for Lockheed Martin. So what we can see here is a strong trend to the upside. And every little dip that has happened here, 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 and here, all have been bought. What does this tell us? It tells us that this stock attracts buyers because when it starts to get undervalued, this stock gets bought up by investors because they know the true value of this company. Being a global defense company, it is well established across the globe. And as we know in today's time, uh, defense is very important as we become more globalized because defense is a strong cornerstone to every sovereign country. Because for a country to operate, defense has to be strong. It has to protect its borders, it has to protect its aerospace and its rights. So, on top of that, Lockheed Martin not only sells to the US government, but it contracts projects towards other alliance to the US. So Lockheed is a perfect company to invest into if you're going to go on the defense route in terms of investing. So this is what we're going to use as an example today because what we can clearly see here is a trend. And when it comes to option trading, trading a trend is the key to consistency. You do not want a stock that moves up and down and moves sideways, although the credit spread will work in those scenarios. But when you have a strong trending stock, it allows for a simpler trading and a simpler P&L when it comes to options. So to trade this stock, we are going to be using credit spreads, and to open up a credit spread, we're going to be using the tastytrade platform to show us how to do it. So this is the tastytrade platform, and this company, tastytrade, is well established within the CBOE. And many traders and investors use this trading platform because this company specifically creates their software for options trading. In fact, the founder of this company actually built the Thinkorswim trading platform. And later on, he sold that company to TD Ameritrade and eventually started his own company, and tastytrade was born. So for this example, we're going to be using a 12-day expiration. And generally to do this, I like to choose anywhere from a 15 to 12 at minimum. You can go either plus or minus, 2 days. But generally, I like to choose a 15-day expiration. So this example, we're going to be using the ticker symbol LMT, which is Lockheed Martin, and we're going to be selling on the July 7th expiration. This is 12 days to the expiration of these contracts. And to open up a credit spread, what we are going to be doing is selling a 9 delta strike. So a 9 delta is this strike right here. And to sell a credit spread, we're going to be selling on the put side. And we're going to choose the 437.5 option strike. So we're going to be selling this strike here by clicking on the bid. And if you scroll down, we're going to be buying the 5 delta, which is the 430 strike. So when by opening this, we are going to be creating a $27 or 27 cents credit. So we can see here down below, the max profit is $27 and our max loss is 723. Now you look at these two numbers, you're looking at it and most people are going to be wondering what the hell? This is crazy. You're only making $27 for a max loss of 700. To me, at first when I started the option trading journey, I looked at that and I was like, what the hell? That doesn't even make any sense. You're risking so much to make so little. But the key here is that we are trying to build a consistent option trading strategy. Now, what happens at expiration is that this $27 will go to zero. But because you sold it, you pocketed this $27 here. And once the option goes to zero, because it does not go into the money, because if we look at the chart right now, right, we see that the actual price of Lockheed Martin is at $458.99. For it for this option spread to go to zero, the stock must not go down to $437.50. So $437.50 is, now let's take a look here. 437.50. That is roughly around this point here. And that is a 5% move to the downside. Now, based off of the way Lockheed Martin is trading, we can see that its recent rejection low was back here in January of 2023. So for the market to sell all the way down to 437.50 is roughly a 5% move down. And every time we tested this level, we've saw buyers step in and move the price higher. So for it to move down to this level will signify us a unlikely chance that it would happen and a unlikely chance that this spread will go in the money, therefore us losing on the trade. But because, let's say if the stock does not move down to this price, this option contract will move down to zero, and therefore we will earn this max profit of $27. So this is how you can create consistent profits when it comes to trading credit spreads. By selling a far out of the money option strike spread, you can create consistency. Now, how do we achieve a double on the account? Well, it's all going to come down to math. So what I have here is a compound interest calculator. And to calculate the percentage gain, if we are collecting $27 and with a max loss of 723, the percentage gain, and what I have here is a calculator, the percentage gain on this, or the percentage return on this max loss amount is going to be calculated by using $27 divided by 723. That's a 3.7 percentage points. So that means it's a 3.7 return on this max loss. So we can earn a 3.7 return within 12 days just by doing this math. Now, the benefit to this is that because we are choosing trending stocks, the direction on the move is going to help us collect premium faster, meaning that the $27 would be realized to us as a gain much quicker if the underlying stock continues to move away from our opening strike price. And so to expand on this, to really realize a double on account, what we're going to be doing is doing simple math. So what I have here is an initial investment of $5,000 with an estimated return of, let's say, 8%. Imagine if we're selling this for a 4% return, and instead of 3.7, we'll just round it up to 4%. But because we are selling every 15 days, you can sell this spread twice in a month, right? Because we're selling every 50 days it's going to go to zero, and we would collect a 4% return on our investment. So imagine this. If we if every 15 days we got a 4% return, we can round up that we are getting an 8% return on our investment every single month. So I put a $5,000 initial investment. We're not contributing monthly, but imagine if we compound the 5,000 every single month at 8%, right? And this is the breakdown here. Your initial investment is $5,000, right? Initial is $5,000, and we're just gonna run down the numbers here. We are trying to find a point where we get double the $5,000, and that is roughly around year 10, or in this example, month 10. So if you're starting on January, by October, you would have doubled your account. In fact, at the end of September, you would get close to it. Assuming that you have no losses, assuming that you have not taken money out of your account, and that you've compounded your funds every single month, you would have doubled your account in roughly 9 to 10 years. Or, I'm sorry, 9 to 10 months. So, isn't that amazing? Right? To double your account within a year by using a simple option trading strategy that will deliver consistency because you are executing on stocks that have a consistent uptrend and that has a high percentage of profit in terms of probability that these option contracts, because they're selling out of the money, they won't ever go into money, and you'll most likely never ever run into a loss. So that is how you can use option as a strategy to double your investment under a year. Now, if you like this platform, if you'd like to get into option trading, I'll provide a link down below for opening an account with tastytrade. They are a phenomenal option trading company that offers a phenomenal option trading platform that makes option trading much simple. And so if you'd like to sign up for it, make sure you check the description down below. And again, if you've liked this video, make sure you subscribe, hit the like button below, and we'll see you on the next one. Peace.